gentlemen, next up we are going to hear about trade, tariffs and markets. So yes, we are going to welcome our speaker, Mr. Gopal Agrawal, who is a senior fund manager at HDFC AMC Limited. And yes, to do the felicitation, to do the welcoming, can I have Mr. Venkatesan to kindly join us? Ladies and gentlemen, put your hands together, please.
So it is indeed my pleasure to be here to present our views on trade, tariff and market. I welcome you all on behalf of HDFC Mutual Fund. So I will be sharing some thoughts on the topic and try to make it more relevant for your business and I will try to give as much as perspective as possible. So very clearly I would like to share, every point of time there are certain anxiety, fear and worry on market. Like today we are talking about worry about trade, tariff, and you are having a global geopolitical war, 3 war which is continuously going on today. So despite all this, which is very important message I want to give, in the long run, the nominal GDP growth rate of the country and equity market return has coincided each other. So if you look at the history of BSE Sensex of the last 40 years, we have got almost 13.4% return CAGR from equity market in line with nominal GDP growth rate of the country, which is 13.2%. So what happens over the long period of time, the nominal GDP coincides with the market return because the earning of the economy is in line with nominal GDP growth rate. So that is more important and more pertinent for you all to understand. As our size of our economy is growing and now we are at $4.6 trillion GDP economy, 4th largest in the world, we are growing in between 9.5 to 11% ballpark range, and it is the potential for Indian economy for the next decade or so. So we should be aspiring to have return in line with that in the next decade. In this, as a wealth advisor, I can tell you for sure your role will be becoming much more important than the past decade, because when you are small, your growth was very fast and you had a great return. Now you need to work hard, and take the clients, more informed about what's happening and take them along. Add to this, market is a slayer of 4 things: earning growth, liquidity and interest rate. The good part is that we are heading already into a phase of very low interest rate. In India, our 10-year GSEC has come down to 6.35%. FD rate has already crashed to 6.5%, and with the injection of CRR money, which will start from September onward, I expect by March 2026 our 1-year FD rate can be 6% or below. Right? So as the interest rates are going down, your business will prosper more, because people will have lack of opportunity to deploy, your hurdle rate will fall, and that is how you will make return over time. Now on the trade tariff, I would like to give you some perspective to all of you. Very clearly, this tariff situation is evolving because Trump is being a businessman. He is changing the stance very fast. You have seen Chinese tariff went to 235%, right? As high as 235%. Now he has brought it down to 30%, and now the negotiation is still on. Right? Still we are continuing with 10% basic tariff on all the country, and various countries have tariff between 20%, 24% to 30%. So still nothing has been concrete. At worst, what will happen, I give you numerically, US inflation can increase by 1.4% because USA has a large import, right? So at worst, US inflation can increase by 1.4%. GDP growth will decline by 0.9%. So it will have its impact on the world growth. Like world growth can reduce by 20 basis point by that. So this is the broad context in which it will happen. And when the US inflation will go up, then what happens? They either have to raise rate or their rate will not come down. So it will have its impact on the global liquidity flows, right? So that is the very broad contour, I would say, on the trade and on the tariff side. But definitely, like this is also an opportunity for a country like India. Like, today in this world, when every country is trying to protect themselves and trying to become more internal looking, then you have to do a lot of things on the manufacturing. You look at what's happening in today on the precious metal side or on the auto side. The Chinese are reducing the export of rare earth metal, right? So in this you have to evolve, you have to make the things in your perspective, right? So this is the manufacturing should look much better than the past, because the second point is that you are seeing the problem of cheap exports from USA, right? And what is happening with the Israel and Hamas war. Like if you have your chip in your mobile phone, like they have killed you by sitting in other country, right? So what does it make? Problem in consumer and chemical. So this year I really expect from second half the consumer company earnings should improve, because what happened last year in October 2024, going into Maharashtra election, we increased the import duty on palm oil by 20%. And palm oil is a big raw material for all these soap manufacturing and everything, right? Even for the all edible oil is linked with the palm oil prices. So the prices went up very fast, and international market prices also went up by 40%. So now prices in international market are coming down. We reduce the import duty from 20% to 10%. So I hope that consumer company earning will recover from here, where particularly in second half because of base effect, and then you have better monsoon, rural economy is improving, so consumer should do better than here. Cement sector will certainly see improvement for sure, because you have seen mega acquisition by large players. So now they have used their balance sheet for acquisition, so they don't have much firepower left for more competition. So they will align, and input prices have come down, especially thermal coal prices are down. So the earnings of cement company should improve from here. That is my view. And I would also say that chemical sector is poised for big growth, because European chemical industry is in trouble, and that is a big opportunity for Indian chemical industry to do well. And add to this, you had a lot of inventory in the system of agrochemical, right? And that has all depleted. So the chemical industry outlook looking promising from where we are. This year, the only deterrent can come, some moderation can come into earnings of banking and financial sector, because last year you had a mega rally in bond market. I showed you from 7.3 to 6.25%. So the banking earning was very strong last year. This year credit growth is weak, and also bond market may not rally. So we have cut the repo immediately, while the benefit of CRR cut will start in second half. So there will be some margin pressure coming to the banking sector. So there will be some moderation in banking earning can come, but recovery will come into NBFC, microfinancial institution, and small finance bank over time. So this is a year of recovery play of tighter liquidity to benign liquidity. So second half looks much promising in this year.